Hey guys, this is Toby Mathis. Today we're going to go over 5 tax strategies for W-2 employees. Let's jump in. Now, first off, I know if you're a W-2 employee, you probably don't have a lot of options as far as deductions. If you're just working a job, you're probably feeling a little bit of that tax exhaustion of you're just getting withholdings and you're hoping that you're withholding enough. Maybe you're getting a refund at the end of the year. And you're probably limited in the different types of tax strategies because you're so used to taking that standard deduction. But with just a few little maneuvers, you might find that there are some tax savings that you can have. Now, I tend to spend most of my time in the investment world where the best tax strategy you could have is to have a small business. And so most of my clients are investors and they have an active business, a family office, or something attached so that they can get a lot of tax relief. But that's not practical for everybody. So there are different strategies that you can use as an individual. And I'm just going to go through them real quickly. Number one, if your employer is offering a 401k, generally a 401k in 2025, you're going to be able to put employee side up to 23,500 on a deferral, which means it's not going to your pay's not going to go to you. It's going to go into the 401k. You still have employment taxes on those, but so there's a little bit of what you'll see almost like a withholding as your employment taxes. Your employer pays half, you pay half. But you are not going to have to pay tax, federal income taxes or state income taxes on the amount that you defer. Your employer can also match, which is tax free to you, which is almost like that's 100% return, anything that they're willing to match. And you can contribute up to $70,000 a year into that particular 401k. Question I get all the time is, can you have more than one 401k? Yes, if you have multiple employers, you can have multiple 401ks, and each one comes with that $70,000 limit. You can add an additional amount if you have gray hairs. Right? For older folks, there's a catch up provision. But that 401k is a great place to start. And if you're wondering how powerful it can actually be, there was a study done, I think it was by Steve Hogan, went over, I think they interviewed over 10,000 millionaires. And when we were looking at the professions of those individuals, what they found is that in the top three was engineers, accountants, and teachers. And so teachers isn't a high income profession, but they were disproportionately represented in the roles of millionaires for precisely this reason: is they're using retirement plans that's deferring the income, they're getting those tax savings, and then it's compounding, and eventually they'll be taxed on it if it's a traditional plan. But things like your 401k are a great example of things that you can do that will come out of your top bracket. Any of those funds that go into that 401k, the way to think of it is whatever the top bracket you were paying, that's what you're saving is the tax savings on that money. So if you put $10,000 in and you're in the 24% tax bracket, from a federal standpoint, you just saved 2,400 bucks, which is great, right? That fantastic. So that's strategy number one. Strategy number two is our triple threat. The HSA, Health Savings Account, is a fantastic tool because it allows you to take a tax deduction for a family in 2025. It's up to $8,550. If you're over 55, it's another $1,000. So you could be, if you're an older person, you could put $9,550 into this plan for your family. If you're an individual, it's 4,300 plus 1,000 if you're over 55. The only condition is that you have to have a high deductible plan. I have those numbers somewhere. What is the high deductible stuff right now? I think it's for an individual minimum deductible is 1,600, 3,200 if you're a family, maximum out of pocket $8,050 or 16,100 if you're a family. So there are some little conditions, but most plans nowadays fit within this, and you're able to write that off. Now, why is that important? Let's pretend again, let's just say your aggregate tax is 30%, right? And, so that when we're saving a dollar, it saves us 30 cents is the easiest way to think about it. So you're able to get 4,300 bucks in there. What is that? So it's over 1,200 bucks that you're putting back in your pocket. You're saving. Now, that money grows tax free. It deferred. I mean, it's not just deferred, it's going to grow tax free. And then when it comes out, so long as it's used for health expenses, it's tax free. So you're getting a tax deduction, tax free growth, and then tax free income. It's better than a Roth where I don't get a tax deduction going in, but I grow and I never pay tax again. You could take that HSA and you could invest it, let's just say that you're putting a little bit of money. And by the way, you don't have to use the money on your expenses right now. You could, It's an easy way of taking things that would ordinarily not be tax deductible. Is, for example, if you're taking the standard deduction and you're not getting a medical deduction because of the 7.5% floor on your Schedule A, if you know what that is. If you don't, it just means that you don't get to write off all your medical expenses unless you go over a threshold, and then you still have to itemize. Most people don't. About 80% use the standard deduction, so you're not getting any deduction. Well, here's an easy way that you could, but you don't have to use it. You can kind of hold that in the bank and say, hey, I'll reimburse that later, future years. But in the meantime, I'm going to let the money that I put in there, let's just say I put in for my family $8,000, and over the next 5 years, that 8,000 turns into 16,000. Fantastic. As long as I use it on health, I don't pay any tax, and I got the deduction when I put it in. Hypothetically, again, let's pretend it's 30%. I got $2,400 tax savings in my pocket just for doing that. So that is a triple threat, the HSA. Number 3 is your IRAs and Roth IRAs. You can contribute into a IRA or a traditional plan. Some people are like, well, but there's income limitations and things like that. There's something called a backdoor Roth that you could do it. You can contribute to a non-deductible into a traditional plan and convert it to a Roth. You never took a deduction, so there's no conversion. You never got a tax deduction, so there's no penalty. Now it's in a Roth. You could also do that with a 401k and actually get up to $70,000 into that Roth 401k. You can go that route. But here's one of the really interesting things about IRAs. Number one, if you're just doing the traditional and your income allows it, then you get a nice tax deduction for putting it in there. Now, the numbers, when you look at a traditional plan and a Roth, are fairly identical over 30 years, so long as your tax bracket stays consistent. So if you think your tax bracket's going to go up, you should be doing a Roth. If you think your tax bracket's going to go down in 30 years, then you should be doing a traditional. That's how the numbers work, guys, right? Everybody's always like Roth, Roth, Roth. And I'm saying not always. But let's say that you think your tax bracket's going to go up in the future. You might want to convert an existing IRA or 401k or part of it this particular year, especially if you had a down year. Let's say that you lost your job. There was 3 months where you weren't drawing a lot of income, or just say that maybe next year you think you're going to kill it, like you're really getting good at your job and you're getting all these bonuses, and you're like, man, this is the last year where I'm going to be in the, in the lower income tax brackets. Maybe, just maybe, you look at it and say, should I convert that and pay the tax now because I know I'm going to be in a higher bracket later? Maybe that's what you do. That's always why you talk to somebody. And by the way, if you ever want to talk to somebody about tax strategies, including, whether you could get yourself structured, how your estate plan looks, and how it all integrates together, just type in the word strategy down in the comments below, and we'll send you a link so you can have a free consultation. Somebody will go over this stuff with you, and they'll see if maybe the juice is worth the squeeze, if any of these things are of interest to you. Number 4, big area, is Schedule A. I was mentioning the standard deduction, which is standard deduction in 2025. It just went up. It's $15,000 as an individual, married, filing jointly. You're looking at $30,000. If you can exceed that for the combination of your mortgage interest that is deductible, your SALT limitation, which is up to $10,000, and hopefully that goes away here, but your state and local taxes, your medical expenses that exceed 7.5% of your adjusted gross income, and you add in your charitable contributions. You add all those things up. If they exceed that 15,000 or the 30,000 if you're married, then you're getting a tax benefit from them. If you are not, like let's say that you're sitting there and every year you're just underneath that standard deduction, you're not getting any benefit. And that's when we look at things and say, should we get chunky with our deductions? And what that means is, should I make extra charitable contributions this tax year, for example, and maybe I put them in a donor advised fund, and I'll use them next year for my charitable giving, but I'll take the deduction this year, or reverse it. Hey, I'm not getting a write-off. I'm going to hold off, and then on January 2nd, I'm going to make my contributions to my charities that I would have done last year, but I'm just waiting until the end of the year, into a new year, and then I double up in 2025, and I take a larger tax deduction in that year. Or if you're doing it, again, it's up to you as to when you do it, but you're putting most of your charitable contributions or those expenses into a particular tax year, so that you exceed the standard deduction, so you get a tax benefit for it. And then the next year you're like, hey, I'm doing zero charitable deductions on my Schedule A. I have my donor advised fund where I'm giving my charitable giving, but I'm not taking a deduction on my return because I've already done it. I took it all in 1 year. That's called getting chunky on that Schedule A. And that works. People do it so that they're getting some benefit for it, as opposed to year after year getting no tax benefit. Now, number 5, and this is our last area that I'm going to get into. So I'm going to say this is 5 tax strategies for W-2 employees. The last one is losses. And there's multiple categories here. When I talk about losses, the most obvious one is if you're investing in stock market or crypto or anything like that, where you have capital losses. And the rule that you need to be aware of is that I can use capital losses against capital gains, up to that capital gains. And I can only use capital losses against my other income up to $3,000 in a year. So in English, let's say that you sold a bunch of Bitcoin and made $100,000. And then you have a bunch of stocks that are sitting there and you have a $20,000 loss. If I sell that stock at a $20,000 loss, I can use 100% of that $20,000 against my $100,000 Bitcoin. No problem. My net capital gains now is $80,000, and it's going to be short term and long term. Short term is if you held it for less than a year. Long terms, if you held it longer. Futures are a little bit different at 60-40, but there are different. There's basically 2 different categories, and the broad strokes are if you held something for over a year, your long term capital gains, which is a different rate, 0, 15, or 20%, versus short term, which is taxed at your ordinary income. So if you have especially if you have ordinary loss and you're sitting here going, oh, shoot. And then you have ordinary gain. Let's say I have some Bitcoin. I bought some and then it ran up and I sold it. So you have the short-term capital gains taxed my ordinary rate. You might want to be looking to see if you have any capital losses, especially long-term capital losses, because it's great when you take a long-term loss against your short-term gain. You get a bigger tax punch when you do the math. It just works out. Now, if we reverse the role here a little bit, and instead of having $100,000 of Bitcoin, we have $100,000 of W-2, and we have $20,000 of loss in either Bitcoin or stocks. They're treated the same. So let's just say that I have stock unrealized losses of $20,000. If I sell it, I'm not going to get to use that $20,000 against my W-2 income. I'll get to use $3,000, and then I'll carry the remaining $17,000 forward. So I have 20. I get to take 3. So that leaves me 17. The next year I take 3. The next year I take 3, and so on until it's used up. But it will lower my taxes by that $3,000. So if you have some small capital losses, like you're looking at it and you're like, oh, this is not a big deal. I've got $5,000 of losses. You may want to take that loss. And by the way, there's workarounds for something called the wash sale loss rule. It's on some of my other videos. But there's ways to still end up with the same shares eventually, and you're able to take that loss. You have to use an option, but there's a way to do it. At the end of the day, what we're looking at and saying is like, gosh, should I go ahead and sell? Even if I just sold $3,000 of the loss, fantastic. It's going to save me $1,000, right? If I'm paying around that 30% mark, it's going to save me $900 in taxes by doing that before the end of the year. So boom, I could do that and take my capital losses. Other kind of losses. If you're a real estate investor, you may not realize this because your accountant's going to say passive losses only offset passive income. Well, there's a few exceptions. If you sell a property, the loss gets released and it offsets the gain from that property plus any other income. It can actually offset your W-2 income. The other one is if you're an active participant in your real estate, which means you hire the property manager. Your accountant's going to look at you and say, well, you're passive. We can't take that. Well, point him to section 469 and say, do I fall into any of these categories? There's 2 of them that will benefit you. Number 1 is the active participation. It's up to $25,000 of losses you could take right away on your W-2 income, even with passive losses from your rental activity. There is an adjusted gross income floor, which means it phases out at $150,000. Between $100,000 and $150,000, it phases out $1 for every $2. So you can get up to a $25,000 deduction. But if you make over 100 grand, it starts to go away slowly until you're at 150, and then it's gone. Right. The other one is real estate professional status. And I have plenty of videos that go over that. But if you are somebody in either you or your spouse, that's what you do is real estate. I don't care if it's construction, development, management, leasing, handling your own rental properties, being a real estate agent, whatever, being a broker. All those things can qualify you as a real estate professional. And then you couple them in with a couple other factors, your material participation on your properties. But what it really comes down to is there's a two-part test where you can actually unlock those passive losses. And because you're a real estate professional, it becomes non-passive, which is absolutely fantastic. Another huge benefit. And then the last type of loss I want to talk about is that business loss. If you are running a pass-through entity like an S Corp, LLC tax as an S Corp, even a sole proprietorship, even partnership, if you have business losses flow onto your return, it can offset your W-2 income so long as you are an active participant in that business. The term is actually material participation. So if you are working in the business that generates the loss, yes, if you have a $100,000 loss, it could wipe out your W-2 income. Absolutely. That's why the number one tax strategy is always going to be having a business. Sometimes they generate losses, most of the time they're making money. Sometimes they break even, but they give us some tax benefits. But if you have something that's a passion project, or you have something that you're interested in, maybe you're doing it on the side, even if it's Uber or Lyft or doing any of those types of activities. Maybe it's doing short-term rentals. That's actually a business, by the way. It's not rental activity. If your average use is 7 days or less, then it can be treated as a business. You can create loss that then offsets your W-2 income, and it can yield some nice tax savings. So especially if you're getting into something where, like, hey, you know what, first couple of years, I might, take it in the shin a little bit, but it's going to go up and I'm going to start making profit. You can absolutely take those losses. And there's a misnomer that it's going to get you audited. What gets you audited is sole proprietors that make around $100,000 to $200,000. They get audited about 1,000% more than anybody else. And the problem is they lose 94 to 95% of the time. So I would just say, if you're starting out and you have some loss, it's not necessarily a trigger. Just make sure that you keep good books, you're tracking your expenses, and that you have an intent to make profit. Reach out to us. We'll show you how to do it so that you're audit proof, so that you can make sure also that you're getting the biggest benefit out of it. There's so many tax deductions available to a business, but what it does to your W-2 income is reduces it, and it comes out of those top brackets first. So it's absolutely powerful. So again, if you have questions on this, go down in the comments below, write in strategy, like, subscribe, ring that bell so that you get notified when new videos come out. I always put a couple out a week. And if you can, share this with somebody that you care about. Good luck.